Welcome back to the deep dive. Today we are skipping the superficial headlines and digging straight into the foundations of financial resilience.
We are.
We know you, the listener, are here not just for a quick summary, but for that complete, nuanced understanding of what makes a successful financial life. And it really starts with a singular, non-negotiable concept.
It absolutely does.
Yeah.
We can talk about sophisticated investment strategies, market timing, early retirement, all of it. But all those strategies, they're built upon the integrity of this one single component. If that foundation cracks, everything else just collapses.
Everything, exactly. I want to frame this for you as the foundational secret to financial resilience. It's not the most glamorous topic, I'll admit.
No, it's not.
It doesn't involve crypto or day trading, but it is, without a doubt, the most crucial. If we were discussing, say, structural engineering, this would be the sheer wall that absorbs the earthquake.
That's a great analogy.
So the central question we're exploring today, and we're drawing this directly from our sources, is how do we inoculate our personal finances against the inevitable curveballs of life? And what are the specific financial viruses this inoculation protects against?
It's an essential framing. And the source material we're working with today, it's a foundational definition of the emergency fund, but it's deceptively simple.
Right.
Our mission here is to move beyond just that definition and really extract the detailed mechanisms and the deep financial why behind this whole concept.
The subject is, of course, the emergency fund, sometimes called the contingency fund. And our goal is to pull out all the operational insights from this core definition to meticulously understand why our sources confirm it is a critical part of financial planning and how its structure protects the entire financial ecosystem you are building.
We really need to understand not just the what, but the mechanics of financial stability it provides. The detailed protections that actually let you sleep at night.
Okay, let's unpack this. We'll start with Section 1, establishing the financial safety net. Let's begin with its core identity, which the source material defines as a personal budget set aside as a financial safety net for future mishaps or unexpected expenses.
What's immediately crucial about that definition is the phrase personal budget set aside.
Yeah.
This isn't just, casual savings. This is an intentional, disciplined act. It demands foresight. It demands structure.
It's not accidental.
Not at all. It means dedicating specific identified funds to a highly specific, though currently unknown, purpose.
That deliberate nature, that's what separates a true emergency fund from just, general checking account overflow.
Right. So many people mistake having a large balance at the end of the month for having an emergency fund.
That is a classic mistake.
But if that money hasn't been mentally, or even better, physically segregated and earmarked, it's just vulnerable to discretionary spending. It can be used for an impulsive purchase just as easily as it can be used for a medical bill. The intention is everything. The act of setting it aside transforms that money. It's no longer potential spending capital or, discretionary investment money. It becomes a dedicated defensive asset.
It changes its job.
It changes its fundamental role. It becomes a dedicated shield. And that leads directly to the core identity, the financial safety net.
That metaphor, the safety net, is so incredibly profound when you apply it to finance. It really implies catching you before a catastrophic financial fall. Think of the structural role of a safety net in high-risk professions, like for a trapeze artist.
Right.
It is the absolute last line of defense. It's a guarantee that a failure up above doesn't translate into a disaster down below.
And it provides a necessary structural buffer. It suggests that the consequences of a major life event, let's say 6 months of unemployment, will transition from what feels like permanent long-term financial ruin into, a manageable setback.
Just a setback, not a total wipeout.
And crucially, we have to note the difference between this safety net and standard insurance. Insurance covers specific named perils: fire, flood, a car collision.
Yeah.
The emergency fund, it covers the liquidity gaps and the unforeseen costs that insurance just doesn't touch.
Or the deductibles that the insurance requires you to pay first.
Exactly. The deductibles themselves are a perfect example of an unexpected expense for most people.
Right. So insurance is highly specialized, but the emergency fund is more like the general practitioner of financial defense. And the targets of this defense are mishaps or unexpected expenses, which stresses the sheer unpredictability of life. A planned renovation, while it's expensive, that's not a mishap.
We budget for that.
But a sudden, massive property tax increase that you didn't see coming, or a failed septic tank, that is the domain of the emergency fund.
The fund is explicitly designed for costs that cannot be scheduled or adequately absorbed within the regular 30-day monthly budget cycle. This intentionality, setting aside money for the unknown, is really the critical first step in establishing financial control.
Now, let's pivot to the terminology, because this is interesting. The sources explicitly mention contingency fund and rainy day fund. Now, while the function is confirmed to be identical, I think the linguistic difference here has a massive psychological impact on saving behavior.
Oh, I agree completely. The language we use often dictates the seriousness with which we approach the task. The term emergency fund is functional, but it's emotionally charged. It triggers anxiety. You immediately think sirens, high stress, immediate action.
It's reactive, right? It implies you only think about the money when the crisis is already at your door.
Exactly. Contrast that with contingency fund. That terminology is often lifted directly from formal corporate risk management, from business continuity planning.
I was just thinking that. It sounds very corporate.
It does. When a corporation establishes a contingency fund, they have done rigorous risk modeling. They anticipate possibilities, even the negative ones, and they quantify the required capital to manage those scenarios formally. It is clinical, strategic, and proactive. It sounds like serious business.
That's a fascinating paradox. So, the person creating a contingency fund implies that they've actively engaged with the possibility of failure. They've run the numbers for job loss, for example, whereas the person saving for an emergency fund might just be saving out of a vague, generalized fear.
And then you have the third term, the rainy day fund. This is the softest, most consumer-friendly language of the three.
It sounds so gentle.
It does. It conjures images of mildly inconvenient weather, a temporary delay in plans, rather than a full-blown financial catastrophe. It's designed to make saving feel less intimidating, more approachable.
I do worry, though, that softer language, while it might be excellent for introducing the concept to beginners, might lead to underfunding. If I'm saving for a rainy day, I might set aside $1,000. But if I'm funding a contingency plan for 6 months of lost income, I'm talking about a five-figure sum.
You've hit on the core nuance. While the source materials confirm the function is identical, it's liquid capital reserve for unexpected, non-discretionary costs. The magnitude of the required capital is often determined by the mental model you're using.
A rainy day versus a hurricane.
Precisely. A $500 rainy day fund won't cover a $15,000 medical emergency. The synthesis for you, the informed listener, is that regardless of the name you use, you must approach the fund with the disciplined rigor implied by contingency planning for massive, critical, necessary expenses.
It's preparation, period. And this connects us directly to the crucial function. Why is this single fund deemed a critical part of financial planning? And what 3 specific high-stakes risks does it specifically mitigate?
That transition takes us right to Section 2, the critical role in financial planning. When the sources use that word critical, they mean the system fails without it. It is the foundational layer of what we might call the financial stability pyramid.
And what happens when that foundation is missing? You expose your long-term goals, every other financial goal, retirement savings, investments, college funds, they all rely on consistency and compounding time.
Exactly. The emergency fund acts as a dedicated financial shock absorber. Without it, when a major event strikes, the capital has to come from somewhere else. And the easiest place to steal money from is your future self.
Oof. Yeah.
That means pulling money out of tax-advantaged retirement accounts, incurring penalties and taxes, or immediately pausing your automated contributions. And when you do that, you lose valuable compounding time that can never be recovered.
So the fund isn't just protecting today's cash, it's protecting the exponential growth trajectory of your wealth tomorrow. It maintains the integrity of your investment timeline. It's the difference between hitting a financial pothole and continuing the journey with minimal interruption versus, having to pull over, call a tow truck, and lose half a day's worth of progress.
It allows your investments to remain untouched and allows your planned saving to stay on track. This protection against derailment is exactly why it earns the term critical. Now let's zoom in on the 3 major financial risks the fund is specifically designed to neutralize. This is where we analyze the mechanics of the defense.
The triple threat. Let's start with risk reduction 1. Becoming dependent on credit. The sources cite this as a primary danger.
And dependency is the key concept here. We are not talking about using a credit card for convenience and then paying it off every month. That's a different thing. We're talking about using high-interest credit standard credit cards, maybe payday loans or high-cost personal installment loans to cover non-negotiable emergency expenses when you have no cash available.
Let's put some numbers on that trap because this is where the financial damage becomes, well, exponentially worse. Average credit card interest rates today are hovering between 20 and 30% APR.
Or even higher in some cases.
For sure. If you suddenly have a $5,000 expense and you throw that onto a credit card because you have no emergency fund, that expense is immediately tagged with a 25% annual liability.
And that 25% APR, it acts as an immediate self-inflicted tax on the crisis. The emergency fund provides immediate zero-interest liquidity. If you use credit, that $5,000 emergency can easily turn into a $7,500 or $8,000 debt burden over 3 years, depending on your minimum payment structure.
So the financial stress just compounds. It makes it significantly harder to stabilize once the immediate crisis has passed.
And the dependence is insidious because once you start using credit to cover basic life necessities, rent, food, utilities during unemployment, you enter a vicious cycle. Your future income, once the crisis is over, it isn't focused on building wealth or investing. It's focused on servicing high-interest debt that was incurred during a past crisis.
You're just paying for the past.
You're stuck. The emergency fund fundamentally buys back your future earning potential by preventing that reliance on high-cost borrowing. It keeps you financially fluid and autonomous. Without it, you are locked into a cycle where your income is perpetually constrained by past liabilities.
That concept of constraint, that flows perfectly into risk reduction too, falling into debt. And the analysis here needs to distinguish between credit dependence, which is sort of a continuous borrowing, and this specific risk, the sudden, massive liability created by a single catastrophic event.
Right. Falling into debt here refers to the sheer magnitude of the financial shock. Imagine an individual facing a $12,000 unforeseen medical bill or a $10,000 home system replacement, like an HVAC. Without cash, they are instantly $12,000 in debt. That's a life-altering number for most households.
It's not just a monthly payment at that point. It's a multi-year repayment cycle that significantly impacts everything else. It can affect your credit score immediately, which then dictates your borrowing costs for things like a mortgage refinance or even just trying to rent a new apartment.
This fund is a crucial defense against those unplanned liabilities that can take years, even decades, to resolve. If you have the emergency fund, that $12,000 expense is handled in cash, preserving your credit score and ensuring your debt-to-income ratio, your DTI, remains favorable.
And if you don't?
If you don't, that high liability immediately impacts your ability to secure better loans or make large planned purchases down the line. It restricts your economic choices for years.
The fund preserves your capacity to save and invest in the future by preventing the immediate creation of massive interest-bearing debt today. It's like the financial fire extinguisher, putting out the big fires before they burn down the whole house.
And this brings us to the third and most existential risk. Risk reduction 3, running out of money in general. This is the simplest concept, but it's perhaps the most devastating.
This is the ultimate buffer, and I really want to highlight the psychological cost here. Running out of money is like running out of cognitive bandwidth. When every single financial decision, from buying groceries to paying a utility bill, is a high-stakes gamble, the psychological stress triggers panic and practical paralysis.
The ability to think clearly, to problem solve, to negotiate a medical bill, or even to perform well in a job interview is severely compromised by that fear and decision fatigue. Our sources emphasize that the fund ensures basic stability is maintained. It covers food, shelter, and utilities, meaning that even during a job loss, you have the necessary mental peace to focus on solving the underlying crisis.
You need the clarity to rework your resume, to interview effectively, to compare job offers, not the anxiety of wondering if you can afford the gas to drive to the interview. The fund is essentially an investment in preserving your psychological capital during a crisis.
It allows you to maintain momentum. The fund mitigates the fundamental vulnerability of modern financial life. The fact that essential expenses are non-negotiable and unpredictable events are, well, they're guaranteed to happen eventually. It is the guaranteed countermeasure, ensuring that your resources are not entirely depleted, allowing stability to persist through the storm.
That synthesis just confirms the strategic defense the fund provides. It protects your long-term goals, and it neutralizes the 3 most damaging threats: high-interest credit dependence, sudden massive debt accumulation, and the profound mental and practical cost of resource depletion.
It's the transition mechanism. It turns a bad situation into a setback with a clear path forward, rather than an all-consuming catastrophe.
Okay, so now that we understand the strategic why, we can move into section 3, the 5 scenarios. This is the practical application. The source confirms the specific categories of mishaps and unexpected expenses the fund is designed to cover. This section is key for you, the listener, to calculate exactly what you are planning for, and we need to go deep on the financial implications of each one.
These 5 scenarios are perfectly chosen because they represent the most common, sudden, necessary, and expensive threats across the domains of income, health, and property.
Let's start with A, use case 1, job loss. The source explicitly states emergency funds may be used in the case of job loss.
This is the premier example. It has to be, because it involves the total cessation of incoming cash flow while your fixed expenses remain. The fund's role here is to provide a runway, or a bridge, between termination and new employment.
A runway, I like that.
And to properly calculate the fund size, you really must consider the stability of your career field.
That's a crucial point for an informed audience, right? It's not one size fits all. A tenured civil servant might only need 3 months of expenses, while a high-earning gig worker or someone in a very volatile industry like tech right now might require 6 to 9 months or even 12.
Exactly, because their income volatility and their replacement timeline are just so much longer.
And we have to talk about the immediate high-cost expenses that are associated with job loss, specifically healthcare. For so many people, losing a job means losing your health insurance.
Instantly.
And that COBRA option, continuing your existing coverage, is often prohibitively expensive. It can cost 100% of the total premium plus a 2% administrative fee. A family plan can easily exceed $2,000 a month.
It's staggering. People are shocked when they see that first COBRA bill.
Oh, absolutely. So the emergency fund isn't just paying for rent and food. It is crucially funding the continued health coverage necessary to prevent a medical emergency from combining with the job loss to create an absolute financial meltdown. You need enough liquidity to manage that exorbitant premium while you're job searching.
Precisely. The fund fills that gap while unemployment benefits, which are often delayed and rarely cover 100% of your previous income, begin to kick in. The size of your fund is directly proportional to the amount of financial and mental breathing room you have during one of life's most stressful events.
Okay, moving on to B, use case 2, medical emergencies. The sources say funds cover medical emergencies.
The focus here is on the suddenness and the non-negotiable nature of the costs. Even with excellent insurance, the emergency fund is essential for covering the initial shock and the immediate non-covered costs.
We really need to acknowledge the difference in insurance structures because that heavily influences the fund size. If you have a traditional, say, a PPO plan, your emergency need might just focus on a relatively low copay and deductible, but
But if you are on a high-deductible health plan, an HDHP, which is increasingly common,
so common now.
your emergency fund must, at a bare minimum, cover your entire annual deductible. Ideally, it should cover your out-of-pocket maximum, the OOPM.
That's the critical insight. An HDHP might require you to pay $6,000 out of pocket before your insurance truly starts to cover significant costs. If you don't have that $6,000 liquid and separate from your daily budget, a sudden accident or illness instantly pushes you into high-interest debt reliance.
And it goes beyond just the hospital bill. Medical crises often entail associated costs. Specialized physical therapy that's not fully covered, non-medical travel and lodging if you need to see a specialist far from home.
Or even specialized nutritional requirements during recovery. The fund ensures that your primary focus can remain entirely on health and recovery, rather than on financing the process.
It removed that terrible dilemma where individuals are forced to delay necessary non-emergency care like a specialized scan or a follow-up surgery because they are constrained by immediate cash flow. The fund ensures you can take prompt action.
Okay, our third scenario, C, use case 3, automobile problems. The sources say funds cover automobile problems.
And here we must first differentiate routine maintenance, which should be a sinking fund in your budget, from a true crisis. A crisis is the sudden failure of a major system, a transmission blowout, a head gasket failure, or significant uninsured accident damage.
And we should highlight that for many, a vehicle is not a luxury. It is a critical asset that is linked directly to your income generation. The failure of the car is a failure of income access.
The cost difference is extreme. A standard service is a few $100s. A major engine repair or replacement, especially on modern complex vehicles, can run $4,000 to $8,000 easily.
That's a huge bill.
It's a massive expense, it's non-negotiable, and it requires an immediate remedy to maintain your mobility. Now, here is a more sophisticated consideration for the listener. The concept of utility loss and replacement.
Explain that.
Okay, so often an unexpected failure occurs on an older vehicle. The repair cost might be, say, $3,000, but the vehicle's book value is only $4,000. Sinking $3,000 into a rapidly depreciating older car often doesn't make financial sense.
The dreaded good money after bad scenario.
Exactly. The emergency fund, in this case, might be used not to repair the old car, but to buy a reliable used replacement car outright, thereby protecting you from a continuous repair cycle.
That shifts the strategy from just fixing a sunk cost to investing in reliable functionality for the future. So the emergency fund should be large enough to handle not just a major repair, but potentially the down payment or maybe the entire cost of replacing a critical income-generating asset.
Absolutely. A swift, cash-based decision means minimal downtime and minimal interruption to your working life. The fund protects the ability to earn a living that the car facilitates.
Let's move to D, use case 4, home appliance repairs and replacements. The sources say funds cover home appliance repairs and replacements.
This one speaks directly to essential home infrastructure. We are dealing with systems that affect your safety, your habitability, and your health. We're talking about a burst water heater flooding the basement, a furnace failure in the middle of winter, or a major electrical system issue.
These are not discretionary. Their failure severely impacts your quality of life. You can't wait weeks to replace a refrigerator that's holding thousands of dollars worth of food, nor can you wait 3 months to secure financing for a new HVAC system in extreme weather.
And this scenario specifically justifies the substantial size of the emergency fund by highlighting the difference between a minor repair, maybe $500, and a full replacement. A new roof, a complete HVAC system, or a septic system replacement can easily be a 5-figure expense.
That's a scary number.
It is. The fund must be substantial enough to cover the high-cost replacement, not just the low-cost repair.
The financial implication here is allowing you to choose the necessary, high-quality replacement immediately, ensuring the safety and habitability of your home, rather than being forced into a cheaper, inadequate solution, or worse, forced to take out a high-interest home equity loan just to replace a furnace.
It maintains the structural integrity of your housing, which is the second most critical pillar of stability right after your income.
Finally, E, use case 5, unplanned travel expenses. The sources say funds cover unplanned travel expenses.
This one is often questioned because travel is generally viewed as discretionary spending.
Right, it seems like a luxury.
It does, but the key, however, lies in the word unplanned and the context of the travel itself.
Let's explore that urgency. This is travel that's necessitated by critical human and family obligations. A sudden death in the family, a severe illness requiring your immediate presence, or some other urgent, unexpected, non-deferrable obligation.
And the financial reality is that urgency equals extreme cost. Last-minute travel flights booked within 24 to 48 hours, emergency lodging, rental cars during high-demand periods is exponentially more expensive than pre-planned leisure travel.
It's unbelievable how much more expensive it is.
You can't just wait for the cheapest flight next Tuesday when you need to be across the country tomorrow for a family crisis.
And the fund enables that response without incurring massive immediate credit card debt for a $1,500 last-minute plane ticket. It funds necessary presence and emotional connection during a crisis, ensuring that the necessary human response is not constrained by financial limitations.
So, to summarize this section, these 5 examples, job loss, medical, auto, home appliance, and unplanned travel, they demonstrate the fund's role as the versatile, primary financial responder for any event that is sudden, necessary, and expensive. They validate the entire defensive structure we've been analyzing.
That brings us to our outro, synthesis and review. We really did a true deep dive here. We unpacked the definition, confirming it's an intentional, personal budget set aside to act as a versatile financial safety net.
And we meticulously reviewed the 3 specific financial risks that the fund is designed to reduce: avoiding reliance on high-interest credit, preventing immediate and massive debt accumulation, and mitigating the paralysis and poor decision-making caused by running out of resources entirely.
And crucially, we quantified the purpose by drilling down into those 5 scenarios provided by the sources: job loss, medical, auto, home appliance, and unplanned travel. And we discussed how the size of the fund must correlate directly with the potential costs associated with these major life events, whether it's a high HDHP deductible or the exorbitant cost of COBRA coverage.
When you look at the source material in its totality, it becomes absolutely clear that the emergency fund is not a mere suggestion.
Yeah.
It is the prerequisite for all other positive financial action. It is the comprehensive insurance policy against having to liquidate investments or take on high-cost debt when life inevitably intervenes.
And here's where the analysis offers a final layer of insight. And this is our final provocative thought for you, the listener, building on these foundational sources. We often discuss the opportunity cost of holding, say, 6 months of expenses in a low-yield savings account, the money that isn't growing in the market. And that's a valid concern.
It is a valid financial calculation, but it misses a more important economic variable, the opportunity cost of insecurity. The most powerful aspect of the emergency fund, as defined by its proactive nature, is the control it affords.
So the critical foundation of financial freedom isn't making your first million. It's securing the agency to navigate financial shocks without compromising your long-term goals. The cost of having money sitting idle is, in this view, far outweighed by the protection it offers against the financial, psychological, and professional cost of having no cash when a crisis demands it.
The act of planning for the unknown transforms anxiety about future mishaps into concrete preparedness and control. You are neutralizing potential chaos before it even manifests. You should think of the emergency fund not as idle cash, but as an investment in your future autonomy.
That autonomy is priceless. Thank you for taking this deep dive with us into the foundational mechanics of financial resilience.
Alexa.